Welcome back to the Deep Dive. We're the show that really tries to cut through all the noise and get you the insights that matter in finance, tailored just for you. And I am genuinely thrilled today. We're tackling something that's, well, it's more than just a headline. It feels like a real shift, how traditional finance is starting to grapple with digital assets. Our mission, like always, is to give you that shortcut, to help you be truly informed so you understand not just what's up, but the deeper why behind these big moves.
And that why is exactly what we need to unpack. It's easy to see these news items in isolation, right? A bank does this, a regulator says that. But the real understanding, the value, comes from connecting those dots, seeing the bigger currents. So today, we've got a stack of material articles, analyses, and we're going deep. We're looking at U.S. Bancorp getting back into Bitcoin services, what it means, why it matters for TradFi, for crypto. It's about the whole system adapting, really.
Absolutely. And this core topic, U.S. Bancorp's move, it just speaks volumes. One of America's biggest banks getting back into Bitcoin. But the really interesting part, the key thing for understanding this, is that it's a re-embrace. They tried this before, didn't they? They hit some pretty big hurdles, and now they're back. Seems like a different approach this time, maybe more confident.
That's what's fascinating, yeah. It's more than just, okay, we offer Bitcoin now. It signals something bigger. It suggests we're entering a new phase, maybe a more mature one, of banks and crypto figuring out how to work together. And it definitely tells us the winds are shifting, politically, maybe, but certainly on the regulatory front. A bank like U.S. Bancorp doesn't make this move lightly. It's a sign of comfort that just wasn't there a couple of years back.
Okay, let's really dig into that re-embrace then.
Yeah.
Because that history matters, right? It adds weight. You mentioned their first attempt got stalled.
Yeah.
Regulatory hurdles, Biden era. Can you give us a bit more on what those challenges actually look like? Why is that context so important now?
Right, that previous snag, as you called it, is absolutely key. Back then, let's say early Biden administration and even before, the whole regulatory scene for crypto in the U.S. was, well, murky is putting it kindly, sometimes even hostile. You had different agencies, the OCC, the SEC, the Fed, sometimes saying conflicting things or just being extremely cautious. Created a lot of uncertainty for banks. And banks, they live and breathe regulation, safety, soundness, scrutiny from everyone. That kind of ambiguity, it's paralyzing for them.
So it wasn't like one specific rule saying no, but more a whole climate of maybe unclear guidance, or maybe just the lack of guidance that created a chill.
Exactly that. It wasn't an outright ban necessarily. It was the lack of clear, positive guidance on how the existing rules applied to these new digital things. Think about it. Capital requirements for holding crypto. Could banks even offer custody legally? How do you apply anti-money laundering rules, the KYC stuff, to crypto? Is it security, a commodity? These huge questions were just hanging there. So faced with that vacuum, institutions like U.S. Bancorp back then basically had to hit pause. The risk of getting it wrong, big fines, damaged reputation, maybe even losing their charter was just too high. Operating in a legal gray zone, that's a definite no-go for a major regulated bank.
Makes total sense. Huge risks versus potential rewards. So that past experience, that difficult snag, what does it tell us about how they're calculating things now? It can't just be, okay, regulators seem nicer, let's go.
Oh, not at all. That experience was probably painful, but incredibly valuable. Banks like U.S. Bancorp, they're fundamentally risk-averse, and for good reason. Fiduciary duty, regulatory oversight. So those past uncertainties likely taught them a few hard lessons. Patience is key. Talking proactively with regulators is crucial, and building a compliance system that's rock solid but also flexible. Absolutely essential. Their strategy now, it's definitely built on a better read of the regulatory landscape, or at least clear signals about where it's heading. They probably had tons of quiet conversations with agencies, maybe even done some pilot programs, asked for formal guidance, anything to make sure this reentry is on much firmer ground. They're trying to avoid another sudden stop. So they start with things like custody, trading areas where the rules are maybe a bit clearer now, or at least more predictable. Not jumping straight into, say, DeFi lending. The reward is still tapping into this growing market, sure, but the risk mitigation learned from last time, that's shaping every single move. It's pragmatic, not just a bold leap.
Right. A pragmatic approach built on hard lessons. Sounds like a clear, maybe even somewhat conservative roadmap. But crypto moves so fast. How do they balance that caution with needing to be agile, needing to innovate? That's a real tightrope walk, isn't it?
It absolutely is. And that's a core challenge for TradFi in this whole space. Their first steps back in will likely be very measured. Secure custody, basic trading, probably just for Bitcoin initially. Build that foundation of trust and compliance first.
Yeah.
But at the same time, you can bet they're investing heavily behind the scenes, R&D, right? Looking at tokenizing real-world assets, how blockchain could change payments, maybe even CBDCs. Often this happens in parallel, maybe in separate innovation hubs, kind of shielded from the day-to-day regulatory heat of the main bank. They're building a bridge, carefully, not just jumping in. So cautious steps now, but definitely planning for more complex stuff down the road.
Okay, that distinction is helpful. Now let's get into those deeper implications. Why does this specific move by U.S. Bancorp really matter beyond just their own business? Let's start with validation and trust. When a huge established name like U.S. Bancorp puts its weight behind Bitcoin, what message does that actually send? Especially people who've been hesitant.
It sends an incredibly powerful message. It's almost undeniable validation. It's not just about making Bitcoin available, it's about making it feel safe. For a lot of people, the idea of moving money from their normal FDIC-insured bank to some crypto exchange felt like heading into the unknown, right? Unregulated, scary stories about hacks, complicated tech. U.S. Bancorp stepping in acts like a bridge, a familiar, trusted bridge. They're basically saying, okay, we've looked at this, we can secure it within our framework, it's a legitimate asset class. That lowers the psychological barrier hugely.
And what about that psychological impact specifically? I mean, if you trust your bank, you see security there, and suddenly they're involved with Bitcoin. That has to reshape how you see it, right? What fears does it calm? And who might this actually bring into the market? Is it a new type of adopter?
Oh, the psychological impact is massive. Think about the average person. Crypto often seemed risky, right? Fear of hacks, losing your money, wasn't sure if it was even legal, the jargon was confusing, felt like it wasn't for them.
Yeah.
Then a brand like US Bancorp, which means stability, regulation, security for like generations gets involved. It normalizes Bitcoin. The message becomes, okay, this isn't just for tech geeks or risk takers anymore. This is a real financial product. It meets our standards. That cuts through a lot of the fear and confusion. You're potentially unlocking what marketers sometimes call the late majority, people who prioritize safety and ease of use. They've been watching, maybe curious, but definitely cautious. This gives them that familiar way in, backed by the bank they already use. It could really change the whole demographic using Bitcoin, bringing in more mainstream, maybe more conservative folks.
That could be a huge catalyst. Okay, moving on. Is this just a smart business play for a U.S. Bancorp new revenue stream, keep up with competitors, or does it signal something bigger about the regulations themselves? Is this like a definitive sign that the regulatory fog you talked about earlier is actually lifting to the whole industry?
I think it strongly suggests it's much more than just a business decision. It's a pretty profound indicator that U.S. banks generally are feeling significantly more comfortable offering Bitcoin services, custody, trading. And that comfort, it doesn't just appear out of thin air. It's not wishful thinking. It implies there's now a level of regulatory clarity, or at least predictable guidance, that simply wasn't there before. Banks just don't gamble with their licenses or their reputations like that. Their return suggests a major shift from that earlier ambiguity that caused so much hesitation. Maybe it's recent court cases like Grayscale versus the SEC pushing regulators towards clearer rules. Maybe it's ongoing quiet talks between bank lobbyists and the agencies, leading to some informal nods or just a better understanding of how the rules apply.
Right. So what kind of clarity might they have gotten? Maybe from the OCC or the Fed? And how does this comfort actually translate into action, like operational decisions, new products? Not just for U.S. Bancorp, but for other banks. I'm supposed to be watching this very closely.
Well, we can speculate a bit. The clarity might be specific, maybe quiet guidance from the OCC, the oversee national banks, or the Fed. Guidance on, say, what's permissible, what the risk management expectations are for holding or trading crypto. Or it could just be a sense that the political appetite for really cracking down hard on crypto has lessened, making regulated participation seem safer. This comfort lets banks actually commit resources, big resources, investing in tech, hiring people with crypto skills, building out those compliance systems, all without fearing the rug will be pulled out from under them tomorrow. For U.S. Bancorp, it means they can confidently offer direct custody, maybe even integrate it right into their online banking. Make buying Bitcoin as easy as opening a savings account. For other banks, yeah, it's a huge signal, almost a green light. We could absolutely see a domino effect, more traditional banks launching similar services, maybe even expanding later into tokenized assets, putting real estate or bonds on a blockchain or offering loans backed by crypto, all within regulated guardrails. That regulatory comfort is laying the foundation.
Okay, this is where it gets really, really interesting. The scale of it all. Let's talk capital flows. We always hear institutional money. Trillions.
Mm-hmm.
What kind of money are we actually talking about? And what's the potential impact on Bitcoin's market if even a fraction of that starts moving?
Yeah, this is where the long-term picture gets exciting. Banks getting back in could genuinely open the door, maybe not floodgates immediately, but definitely open the door to literally trillions in traditional finance money. Money that could start to steadily, trickle into Bitcoin and maybe other digital assets eventually. It's not going to be a sudden flood causing chaos. It's more likely a significant, steady stream over time. Let's think about the assets under management. Wealth management arms of these banks, huge pension funds, sovereign wealth funds, big corporate treasuries. Most of them have been on the sidelines. They manage unimaginable amounts of money, but they have strict fiduciary duties. They have to act in their clients' best interest, minimize risk, ensure compliance.
That trickle, not a flood. That feels like a really important distinction. Why is it a trickle? And what are the ways this capital might actually flow in? And crucially, what does that mean for Bitcoin's market cap, its price stability over the long run?
The trickle is key because TradFi moves cautiously, always. Their due diligence is intense, those fiduciary duties are serious, compliance rules are complex. They won't just YOLO into a volatile new asset. So the capital will likely flow through specific regulated channels. Think about wealth management divisions allocating a small slice, maybe 1 to 5%, of client portfolios to digital assets like they do with other alternative investments. Pension funds might start exploring Bitcoin exposure, maybe through regulated custody or specific investment funds. High net worth clients and family offices get a secure way to hold BTC right alongside their traditional assets with proper reporting and security. And this steady, measured inflow, it's actually much healthier for the market than some sudden speculative frenzy. A flood could just create a pump and dump. A gradual trickle lets the market absorb the capital, build a stronger base, and foster more organic, sustainable growth. This sustained demand, even if it's incremental, can definitely push Bitcoin's market cap up over time, and it hugely contributes to price stability. More institutional players mean more market depth. Bigger trades can happen without causing wild price swings. It reduces volatility. These players also tend to be less reactive to short-term noise than retail, acting as a kind of stabilizing force.
That makes a lot of sense. Deliberate, measured growth, not unsustainable hype. Okay, let's trace those ripple effects through the ecosystem, starting with the most direct impact, investors and traders. For the everyday person, the retail investor, what does U.S. Bancorp offering Bitcoin actually mean for them trying to buy some?
For the everyday person, it means much easier, and maybe more importantly, simpler access. Directly through platforms they already use and trust their bank's app? Probably. Think about it. Right now, getting into crypto often means signing up for a whole separate exchange, right? New verification, linking bank accounts, learning a new interface. It can feel like a hassle, or even intimidating. Imagine just logging into your regular banking app, seeing your checking, savings, and an option to buy Bitcoin right there. That removes so much friction. It makes it way less daunting for people who aren't super tech savvy or just don't have the time to figure out a dedicated crypto platform. It brings Bitcoin to them instead of making them go find it. That convenience factor alone could be huge for adoption.
Yeah, that sounds like a big step towards the mainstream, taking away those barriers. Now, what about the big players? The institutions, wealth managers, pension funds, corporate treasurers. How does this change their thinking, their approach to Bitcoin?
For institutional investors, this is really a game changer for how they see risk and how they do their homework, their due diligence. Wealth managers, pension funds, endowments. They'll feel much, much safer working with a federally regulated bank offering crypto services. It's that stamp of regulatory approval. Plus, the established infrastructure, the audited systems a bank provides, it fundamentally lowers the risk, both perceived and real, of dealing with digital assets. These institutions have really strict compliance rules, fiduciary duties. They have to protect the assets they manage. Knowing their Bitcoin is held by a regulated entity, subject to the same kind of oversight as their stocks and bonds, it makes the whole due diligence process way easier. It ticks boxes around security, insurance, audits, reporting, all critical for managing other people's money. It basically opens Bitcoin up to a whole segment of the market that just couldn't or wouldn't touch it before because of those institutional level requirements.
Right, so it moves Bitcoin out of that Wild West category and into something that fits within their normal risk management. Okay, and for the active traders, people watching the charts all day, What's the takeaway for them from more banks getting involved?
For active traders, bank adoption means more on-ramps, definitely. But the big thing is liquidity, a significant increase in market liquidity. Liquidity is just how easily you can buy or sell something without messing up the price too much. Think of a busy market versus a quiet shop. When big institutions come in through banks, they bring serious capital, serious trading volume. That deepens the order books, more buy and sell orders sitting there at different prices. And this increased depth, it can really tighten the spreads. That's the gap between the highest buy price, bid, and the lowest sell price, ask. Tighter spreads mean less slippage on trades where the price you get isn't what you expected, and just better execution overall. This also helps stabilize the market. Bigger trades from institutions maybe can be absorbed without causing huge price jumps or crashes. It dampens volatility. So for day traders, quant funds, even long-term investors making large buys, it means a more robust, more efficient, probably fairer market to trade in. Good for efficiency, good for stability.
Sounds like a win for pretty much everyone as the market gets more mature. Okay, let's zoom out a bit. Broader ecosystem implications. You mentioned U.S. Bancorp isn't the first mover here. Others are already playing in the sandbox. So what does their reentry tell us about the competition heating up among the big banks?
Yeah, absolutely. They're joining a game already in progress. JP Morgan's been busy with Onyx, their own blockchain stuff, JPM Coin for years. Fidelity Digital Assets, they were super early with institutional custody back in 2018. And BlackRock, biggest asset manager in the world, getting that spot Bitcoin ETF approved, that was huge. So US Bancorp coming back in, it just underscores that no major bank wants to get left behind here. The competitive pressure is intense. It's not just about cutting fees like in some mature markets. It feels like a race to innovate and a race to hold on to client assets. Every bank wants to be the place clients go for digital assets, whether that's direct custody, ETFs, maybe even fancier blockchain stuff later. They're all trying to grab a piece of this growing market, realizing that sitting it out is just not a viable strategy anymore.
That dynamic is crucial. Which brings us to a really interesting question people often debate. Does all this institutional involvement mean banks are suddenly going to plug right into DeFi, decentralized finance, which seems kind of the opposite of traditional banking? Are we building a real bridge?
Well, in the short term, no, probably not directly plugging into permissionless DeFi protocols like a crypto native would. There are just too many hurdles, regulatory, security, technical, for that kind of direct, immediate, anything goes integration. But this whole TradFi re-engagement led by players like US Bancorp, it absolutely could speed up the building of a more controlled, more secure bridge between traditional finance and Web3. It builds trust, it sets up familiar infrastructure, it validates the underlying tech, all of which could eventually lead to more complex but still regulated integrations later on. Think of it like building a proper highway between two cities that only had rough dirt roads before. The first step is the secure on-ramp, not merging straight into DeFi's sometimes chaotic traffic.
Okay, so what are those big hurdles stopping a direct plug-in today, like the main roadblocks? And what are the steps or maybe intermediate technologies that could actually build that bridge, even if it's not full-on permissionless DeFi right away?
The barriers are pretty significant, first off. Regulation. DeFi is mostly pseudonymous. Anyone can use it. Banks operate under strict, know your customer, anti-money laundering rules. How do you square that circle with stuff? Second, security. Let's be honest, DeFi has had its share of hacks, exploits, rug pulls, billions lost. Banks handle client money. They cannot tolerate that level of risk. Their security standards are incredibly high. Third, just tech compatibility. Old banking systems weren't built to talk to smart contracts on public chains without a lot of work, a lot of new secure layers in between. But the bridge is being built just piece by piece. We're seeing tokenization of real-world assets, RWAs, putting things like real estate, bonds, even art onto a blockchain as digital tokens. That makes them easier to trade, easier to own fractions of, all within a regulated setup. Regulatory sandboxes are another thing. Banks experimenting with this tech under supervision with specific rule waivers. Down the line, maybe we see hybrid models, regulated players offering access to a curated list of vetted DeFi protocols, or private bank blockchains finding secure ways to interact with public ones through specific bridges. It's an evolution, driven by practical needs and regulatory green lights, not a sudden revolution.
That lays out a much clearer path forward. Okay, stepping back again, looking at the big picture trend. All of this U.S. Bancorp's return, more institutions getting involved, building these careful bridges. What does it mean for how we even perceive crypto? Is it still as rebellious, outsider money, or is it becoming something else?
I think this signaled a really profound shift. Crypto is moving from being seen as outsider money, a fringe asset, mostly for speculation, towards becoming an integral, almost foundational part of the core financial infrastructure. It's moving past just speculation and showing real, practical utility inside the established system. For years, TradFi has run on old rails, right? Swift, ACH, clearinghouses, often slow, sometimes costly. Now, digital assets and blockchain are showing they can complement that, make it better, sometimes even replace parts of it, offering potential gains in speed, cost, transparency. It feels like a re-architecting is starting, not just adding a new asset class.
What does it mean for something to become core financial infrastructure? How did that change the story, change the narrative around crypto for policymakers, for the public, getting away from that outsider view?
Core financial infrastructure. That's the fundamental plumbing, right? The systems, the networks, the rules that let money and assets flow through the economy. It's the invisible stuff that makes everything work. When Bitcoin, or blockchain tech more broadly, starts integrating at that level, it's not just about trading anymore. It's about potentially making those pipes work better, faster, cheaper, more transparent, maybe more resilient. For policymakers, that changes the conversation dramatically. It shifts from how do we control this risky new thing to how can we use this technology to improve our financial system, lower costs for people and businesses, encourage responsible innovation. For the public, it reinforces the idea that this isn't just a fad or only for speculation or illicit use. It's becoming a legitimate, probably enduring part of the future economy. It moves from something you maybe gamble on to something that could eventually underpin how you get paid, how you invest, even how property is recorded.
Okay, to really get the full picture here, it helps to look at some specific examples, some case studies from the industry. These aren't isolated. They're all part of this bigger story. Fidelity, for instance. They were one of the first big TradFi names to really step into crypto, weren't they?
Oh, absolutely. Fidelity Digital Assets, FDAS. They were pioneers, launching way back in 2018 with Bitcoin custody for institutions. That was a huge early signal, a really respected financial giant saying, okay, we're taking this seriously as an asset class for our institutional clients. And they didn't rush it. They spent years researching, building the specific infrastructure needed. It wasn't just a side project.
What lessons can we take from what Fidelity did back then? How did they manage that early regulatory uncertainty when almost everyone else was staying away?
Fidelity's move was really a textbook case in strategic patience, talking to regulators, and just building for the long haul. Like I said, they didn't just jump in. Years of research, building purpose-built systems for custody and trading. They understood institutions needed institutional-grade everything. Security, compliance, reporting, which the early crypto market didn't really offer. The big lesson. Institutions can enter uncertain markets if they absolutely nail the compliance, build fortress-like security, and constantly talk to clients and regulators, educating them. They proved there was real, if initially cautious, demand from institutions that needed a trusted, regulated partner. Their careful success definitely encouraged others to start looking seriously at this space. Paved the way, really.
Then came BlackRock's Bitcoin ETF approval. That felt like an earthquake, didn't it? Just massive news.
Monumental is the right word. Yeah, BlackRock getting its spot Bitcoin ETF approved. That just blew the doors open for mainstream access, both institutional and retail. Suddenly, investors could get Bitcoin exposure through something they already understood and trusted in ETF. As easy as buying Apple stock right in their normal brokerage account. It wasn't just another product. It was this huge legitimizing event for Bitcoin as a mature, investable asset. And the inflows we saw right after just showed how much pent-up demand was waiting for that familiar, regulated wrapper.
How does the impact of an ETF like BlackRock's compared to the direct custody services like U.S. Bancorp is offering now? Who benefits more from each? What's the strategic difference there?
They really serve different, though complementary, parts of the market. An ETF, like BlackRock's IBIT, is mostly for investors who want price exposure to Bitcoin without the hassle. So wealth managers advising clients, maybe smaller institutions, and definitely retail investors who don't want to deal with private keys, wallets, all the crypto tech stuff. The ETF handles buying, selling, storing the Bitcoin securely. It's passive exposure in a familiar package. Direct custody, like from U.S. Bancorp, is more for those who want actual ownership of the Bitcoin itself. Think larger institutions, high net worth folks, maybe corporate treasuries who want the asset directly on their balance sheet for strategic reasons. Long-term holding, maybe future use in lending or other strategies within a regulated bank environment. So ETFs bring broad access and massive passive capital. Direct custody offers more control and flexibility for those wanting to hold the underlying asset within their bank. Both are super important for integrating Bitcoin deeper into finance.
And JP Morgan hasn't just been watching. They've been actively building their own blockchain tech for a while now.
Exactly. JP Morgan's Onyx platform is proof positive that big banks aren't just adopting crypto, they're innovating with the underlying blockchain technology, often behind the scenes for things like interbank payments or tokenizing assets. Onyx isn't about letting retail buy Bitcoin. It's an enterprise-grade blockchain designed to rewire TradFi's plumbing, particularly for wholesale payments and digital assets. Think JPM Coin, their dollar-pegged stablecoin for institutions, or using it to tokenize securities, make interbank transfers instant. It's strategic, leveraging blockchain's efficiency, but in a controlled, permissioned way.
How is a private permission blockchain like Onyx fundamentally different from public ones like Bitcoin or Ethereum? What problem is it trying to solve specifically for TradFi?
It's a night and day difference, really. Public blockchains, Bitcoin, Ethereum, they're open, decentralized, anyone can join. Their goal is censorship resistance, global access, transparency, community control. Onyx is private, permissioned. Access is tightly controlled by JP Morgan and its approved partners. The intent is totally different. It's about taking blockchain's benefits like instant settlement, efficiency, less counterparty risk, and applying them to existing large-scale financial processes. Interbank payments, cross-border wholesale stuff, tokenizing assets within the regulated system. So the impact is mainly on back-end efficiency, cutting costs for big institutions, making multi-day settlements happen in near real time, streamlining operations, maybe freeing up collateral faster. Bitcoin's impact is a new monetary system. Ethereum's is a decentralized app platform. Onyx is TradFi, using the tech of blockchain, but keeping centralized control and focusing on making existing wholesale finance better, faster, cheaper. Optimizing the current engine, not replacing the whole car.
And it's not just banks. Web2 companies are jumping into. PayPal launching their PYUSD stablecoin definitely made waves. Huge user base there.
Oh, absolutely. PayPal's PYUSD stablecoin, which they did with Paxos, that really showed how the big fintech players from Web2 are moving into crypto services aggressively. And that puts serious pressure on traditional banks. PayPal has, what, hundreds of millions of users? Offering a stablecoin brings crypto utility directly into everyday payments for a massive audience that isn't necessarily crypto native. It's less about speculation, more about practical use, easy payments, maybe cheaper remittances. Basically, a digital dollar moving fast and cheap.
What role do stablecoins like PYUSD play in bridging TradFi and crypto, especially for payments? And how does a giant like PayPal getting involved change the game for traditional banks?
Stablecoins are a critical bridge. Maybe the most immediate one, because they offer the stability of fiat, like the dollar, but with the speed and programmability of blockchain. They're designed to hold their value backed by reserves, so they're great for payments, sending money internationally, even just holding value during market dips without Bitcoin's volatility. PayPal launching PYUSD. It's a huge signal to banks. It says, look, mainstream users want efficient digital dollar transactions, and they're comfortable using these products from brands they trust for everyday stuff. That puts huge pressure on banks. They need to innovate in payments or risk losing ground, especially in cross-border transfers to these nimble fintechs. Banks have to think seriously. Do we launch our own stablecoin? Integrate existing regulated ones? Use blockchain to improve our payment rails? If they don't adapt, companies like PayPal will just step in and eat their lunch, potentially cutting banks out of core payment flows.
Then there's the really extreme example. Shows how far this could potentially go, even if it's way out there compared to what U.S. banks are doing.
Right, you have to mention El Salvador.
Yeah.
Making Bitcoin legal tender, integrating it into their banking system alongside the US dollar. It's totally unprecedented, an extreme case of crypto bank integration at the national level. Offers a fascinating, though very high-risk look at one possible future. But the context, the risk profile, completely different from a US bank's careful steps. It was a bold, top-down government move.
Even if it is an extreme case for U.S. banks, what can we learn from El Salvador's experiment? Positives, negatives? What are the takeaways when a whole country tries this?
El Salvador offers tons of lessons, both good and bad. On the positive side, it really highlighted the potential for financial inclusion. It gave many unbanked people access to digital payments through the government's Chivo wallet. It showed Bitcoin's potential for remittances, possibly cutting costs for people sending money home, which is huge for their economy. It also forced local banks to innovate to figure out how to integrate Bitcoin. But the negatives are really stark and relevant. Bitcoin's volatility, that's a massive challenge for a national currency. Created economic uncertainty, a lot of public doubt. The rollout was very fast, top-down, led to tech problems with the wallet, adoption wasn't maybe as high as hoped, And major international bodies like the IMF raise serious concerns about stability and illicit finance risks. For U.S. banks, the lesson isn't make Bitcoin legal tender. It's understanding the huge societal and infrastructure changes involved. It shows the massive need for public education, rock-solid infrastructure, and really carefully designed regulations that manage risk while still allowing innovation. It's a cautionary tale, too, about trying to do too much, too fast, without broad support and meticulous planning. The tech has potential, sure, but integrating it nationally is incredibly complex, even dangerous if not done right.
Okay, let's shift gears slightly. If we wanted to actually track this trend, this evolution of banks and crypto beyond just reading headlines, what data should we be looking at? How do we measure the real impact? Thinking like analysts now.
That's a great question, and it helps you, listening, think critically about how to see these changes in the numbers. There are several key things we'd want to watch closely. First, a bank adoption timeline, just mapping out which U.S. banks, big ones, regional ones, have started offering crypto services, maybe stopped, started again since around 2020. That visualizes the trend, the institutional interest, how comfortable they feel with the regulations. Are more banks steadily coming in? That's a key indicator. Second, Bitcoin price versus institutional inflows. We need to correlate BTC price moves with known institutional buying. We can get data from custody providers, company filings, ETF flows. Does bank adoption actually lead to sustained price increases? Or is it more about steady accumulation that maybe dampens volatility? Are inflows leading or lagging price? Help separate hype from real demand. Third, compare ETF inflows versus direct banking custody. This tells us how institutions prefer to get exposure. Are they mostly using the easy passive ETF route, or are more opting for direct custody through banks, suggesting they want direct ownership for more strategic reasons? Shows different investor preferences. Fourth, liquidity heat maps on exchanges. These charts can show if new players like US Bancorp are actually deepening the market, tightening those bid-ask spreads. Are larger orders getting filled more easily without moving the price much? That's a direct measure of market health and efficiency. And finally, on-chain adoption metrics. Looking at the blockchain data itself. Are active Bitcoin wallets increasing? Is transaction volume going up? Are transactions getting larger? If we see these metrics rise alongside bank adoption, it suggests broader user growth and network health beyond just institutional holding. Are people actually using it more?
Okay, each of those metrics tells a distinct part of the story, gives us a much fuller picture, almost 3D. Why are these specific ones so important? What does each tell us about Bitcoin really maturing and integrating into the financial system?
Right. Each gives a unique lens, the bank adoption timeline. That tells us about institutional acceptance and the regulatory vibe. It's the big picture view of TradFi's stance, are they warming up or getting cold feet? Price versus institutional inflows helps us understand the market impact of this new money. Is it sustainable, institutionally driven price support, or just speculative froth? Crucial distinction. ETF versus bank custody reveals investor strategy and sophistication. ETFs mean passive exposure is popular. Growing bank custody suggests deeper integration, direct ownership becoming more important for strategic plays. Liquidity heat maps measure market efficiency and resilience. Better liquidity means a healthier market for everyone, lower trading costs, more stability, a tangible sign the market's maturing. And on-chain metrics give us a peek into actual usage and network growth. Institutional buying is one thing, but are more people actually using Bitcoin? That validates its utility beyond just being digital gold and signals organic growth. Put them all together and you get a really dynamic, holistic view of Bitcoin's journey into the financial mainstream.
This has been absolutely fascinating, a real deep dive into U.S. Bancorp getting back into Bitcoin. We've covered how it signals that shift in regulatory comfort brings validation, maybe unlocks huge amounts of TradFi capital. We looked at the ripples for retail, institutions, traders, how it ramps up bank competition, and how bridges to Web3 are being built carefully.
Yeah, and the big takeaway really is that crypto is moving rapidly from the edges towards the core of finance. TradFi institutions aren't just watching anymore, they're actively engaging, innovating, integrating. It's a fundamental shift that's going to reshape finance over the coming years, moving from just an idea to a strategic necessity for these players.
And hey, before we wrap up today, if you found this deep dive useful, if it gave you some insights, we'd really appreciate it if you could, hit subscribe, maybe leave a comment with your thoughts below. Share it if you think others would find it interesting. Your engagement, it genuinely helps us out. Boost us in the algorithm, lets us keep making this kind of content for you. So we've explored all these implications of banks like US Bancorp re-engaging with Bitcoin. And it leaves us with a pretty big question, something for you to think about after this deep dive. As Bitcoin gets more integrated into the mainstream system, adopting its security standards, its regulatory frameworks, does it still keep that original spirit? The decentralized outsider currency meant to bypass the banks? Or is it inevitably changing into something Well, something different. A new kind of digital asset, maybe increasingly influenced by the very institutions it aimed to disrupt. Definitely something to ponder as this whole evolution continues.